I've got a background, as you can read from that, in sort of working with big enterprises on sort of disruptive models for delivering service and transforming these organizations. And about 4 years ago, I had an opportunity to break during work, spent some time with my little girl, and I came across crowdsourcing as a really interesting model. In fact, I was using crowdsourcing to try and create another business, and I thought, my goodness me, this model is much more interesting than this silly idea I've got for this business over here. So about 4 years ago, we started investing in trying to understand it. Now, obviously, today's session is about crowdfunding, but I want to put crowdfunding in the context of sort of what's going on and what's happening here, because if you look at crowdfunding from the point of view of sort of following the money, then you might get to learn where the bets are being placed. But you won't understand why those bets are being placed in the first place. So there's something very different going on that's in fact bigger than this. So it gets louder if you do that. Today's session is about whether crowdfunding as a new model for capital formation has the potential to disrupt traditional funding models. Is it going to provide a safe environment? Is it going to be sustainable? And at the end of the day, is it going to help companies start? Is it going to help them grow? And through that, is it going to create jobs? So I do go to events, and I do hear people that have maybe become involved in crowdsourcing and crowdfunding in the last year or so, and they present it as an instrument that's been created quite recently to fix the fact that our capital markets have been locked up, that capital is sort of very much out of the reach of many small businesses and entrepreneurs. But this change in how we started behaving online started happening many, many years ago. I mean, we can trace some early examples back as much as 10 years or so. So, our desire or our acceptance of being sort of passive in terms of the way that we engage and, keeping our ideas and thoughts to ourselves, we've started breaking out of this mold and this model. And it's largely been enabled by a number of things. First of all, obviously, we have great infrastructure now, so we can collaborate very easily, we can communicate, we can transfer large packets of data around. We have payment systems that allow us to move very small amounts of money around for very, very minimal cost. Previously, it was very prohibitive to do that. So if you were either trying to transfer some money or pay somebody for doing some work, that in itself was a barrier. So crowdfunding is grounded in our desire for social experiences. It's an opportunity for us to express our views and our opinions. It's an opportunity for us to get involved with a project that we're interested in, to sort of aspire to become part of something that's bigger than ourselves. So obviously, if we, as we go through our panel sessions today and talking to Ryan and Slava, who run portals, we're going to have a discussion regarding the types of investors, the types of entrepreneurs, the types of funders and fundraisers that are on this platform, and try and understand a little bit more about exactly what's going on here. Just over a month ago, we published the first ever report on the industry. We were in a very unique position to collect it. We, as I said, having been working with these platforms over the last few years, there wasn't a reliable data set. So we went out and we surveyed, there's about 450 platforms altogether. We had about 172 of these platforms provide us with very, very substantial data. In looking at that data, it became very clear to us that there was in the region of about 450 platforms as of about April when we did this survey. But the market's growing at quite a substantial rate. So we estimate by the end of this calendar year, there'll be as many as 500 plus platforms in existence. Now, these numbers don't take into account the impact of the Jobs Act. So quite clearly, there's a lot of companies that are working to build platforms that will be operational sometime during the course of next year. The 270 days stipulated as the period from the enactment date of the Jobs Act runs us to about January. We are in touch with the regulatory authorities, with SEC and FINRA. We're meeting with the SEC earlier this week. So it's a little difficult to gauge at the moment exactly when the new rules and the guidelines will be put in place, but it should be sometime early next year if we're fortunate. So North America is the largest from a platform point of view, so it has the most number of platforms, but Europe is growing very, very quickly. So North America is about 10% larger at the moment in terms of the total number of platforms, but Europe is growing at about twice the compound growth rate of the US. So obviously over the next couple of years, it'll be very interesting again to see whether those numbers change. Now, one thing that we're very aware of as well is that there's a tremendous number of new platforms coming onto the market that many of which we think are underfunded. So the cost of entry in terms of coming in to launching a portal is becoming it's not high. One of the sources of revenues from these funding portals, and not all of them are doing this, is to actually white label their platforms to other providers. So we get contacted probably a dozen times a week by people all over the world who are looking to get into the market. So obviously, our concern in that regard is that many of these platforms, many of these newer platforms, are not appreciating not only the cost of launching and operating a platform, but sort of the ecosystem that needs to be put around it. Portals, on average, in the US, they make their money through charging a transaction fee. The average transaction fee in the US is 7%, we found, and the transaction fee across Europe is slightly higher at 8%. If we look at where these platforms are, as I mentioned, the majority of these platforms are in North America and in Europe, but we're now starting to see sort of a proliferation of platforms throughout the other continents, the rest of the world. Now, there are about 4 platforms in China. We didn't have anybody on our team that spoke Chinese. We weren't able to liaise with those, but we've got a pretty good idea of the rest of those platforms. Very interesting one, which I sometimes point out, is one of the oldest securities-based platforms is a platform called ASOB in Australia. I think it's called the American Small Business Offerings Board. And they've been in existence since 2005. So we've actually got some very, very good data in terms of looking at what's happened over the course of those 7 years. They've currently raised $124 million in total funding. They had 176 companies that have been funded by them. And then some interesting data, about 40% of those companies have actually exited through trade sales. 6% of those companies have gone on to register on traditional stock exchanges. And then 86% of those companies are still in existence. So some very interesting data. And they're reporting fraud rates of something single digit, something like sort of 4%. So it's a good example of one of the platforms with some sort of historical, empirical data that we can look at. So we define 4 different types of models. These are the 4. Equity-based, where obviously there's a security offered in some form. That's either in the form of equity, revenue share, or profit. Reward-based platforms, which involves the fundraiser offering tokens and gifts, etc., as a reward in terms of the contribution that they receive. And then lending-based, debt-based platforms, then donation-based platforms, which are largely sort of driven for philanthropic and sponsorship reasons. The reason that we split both the reward-based and the donation-based in part is because the behaviors that drive those, the motivations are very different, and reward-based platforms are growing at a very substantial rate. So as I mentioned, this is looking at the data from the point of view of how they're growing from a revenue perspective. So equity-based platforms this is by number of CSP. So equity obviously is a lot smaller. There's $112 million of equity-based crowdfunding that we identified in 2011. And obviously the majority of that is in Europe. I mentioned ASOB. There's a couple of other companies, Seedups, and then a couple of smaller companies in the UK, Ireland, and in Holland that are all operating legally. We identified about $1.5 billion of total funds that had been raised across these different categories. And this is the first time this data had been raised. So the actual funds raised have been growing at about 60% a year over the last 3 years. Donation-based platform still makes up the vast majority of that revenue number. Lending base is growing their book about twice as fast as donation base, and they account for about 2/3 of the market. Now, the fastest growing platform from a revenue point of view is the reward-based platforms. We're seeing over 500% growth in that particular area. And this is made up of just over 1 million projects. Now, about 1 million of those nearly 2 million projects are actually, or campaigns, are actually donation-based campaigns. But so far, 2011, there's just under 1.2 million campaigns that were completely funded on, through these platforms. So I'm going to introduce the other panel members. So
my name is Daniel Zimmermann. I'm a partner at WilmerHale. I work a lot with emerging growth companies, and I've been dealing a lot with crowdfunding issues and everything around it, securities law exemptions and things like that. I'm going to talk about that a lot.
And I'm Don Ross, and I'm a managing director and founder at HealthTech Capital, and also a board director at Sandhill Angels. So I have an inherent interest in the startup investment community. Also heavily interested in providing value-added dollars. That's the mentoring and working with companies is a huge part of, let's see if we can get a little less feedback there, it is a huge part of the business model at HealthTech Capital and a big part of angel funding.
Ryan Caldbeck, I'm the founder and CEO of CircleUp. CircleUp is an equity-based crowdfunding site that opened 60 days ago, yesterday. We focus on consumer product and retail companies with more than $1 million in revenue.
My name is Slava Rubin. I'm founder and CEO of Indiegogo. We're the world's funding platform where anybody can raise money for absolutely any idea. We opened up about 1,700 days ago. So my dad died of cancer when I was 15, and that really sucked. I'm a Russian Jew born in Belarus, which basically means that I keep my emotions to myself. And I just dealt with that for a little while. People ask me, you know, like, do you have a dad? And I just didn't want to deal with it. I played sports. I did okay at school. And 10 years later, I decided to finally do something about it. And I always have New Year's resolutions. Can you guys hear me? I always have New Year's resolutions, and I always actually follow up on them to actually make it happen. So in the middle of the last decade, around 2003, 2004, I decided that I wanted to start my own charity for cancer research so that I could actually deal with my own problems. And I started Music Against Myeloma. My dad died of multiple myeloma, which is a form of bone marrow cancer. And with another partner, we started this charity. And you know, raising money, I thought I was very innovative. I wanted to raise money on the internet, and it really just sucked. You know, so then the second time I did it, you know, I used email and PayPal and MySpace and even Friendster back then, and it just like sucked. And we kept on doing it in 2005. Think about this, 2006. You have YouTube is not owned by Google, Twitter is nascent, MySpace is bigger than Facebook, Obama is not a word. And we're just like, why is this so bad? So I meet up with two of my friends, so Eric Schell actually, and my becoming my co-founder, Danae Ringelman. The three of us are having dinner in the Bay. We're looking at the Golden Gate Bridge, and we're saying, hey, so Eric was on the board of a theater company, and Danae has been working as a banker, working with different filmmakers to raise money. Like, oh, all of us are having these challenges to raise money. And if you can remember back then, you have Kiva's kind of doing interesting stuff, and Prosper just started. And you know, social media is not really a word yet per se, but there's something special going on. So we thought, well, why not create a platform, kind of like eBay or something, where you just democratize funding? Well, that seems easy, just stocks and whatever. So we decided to launch in January 2008, and we did that. It was like January 17th or something. I don't know if that's really 700 days. I tried to do the math real fast. But and we launched, and now we're you know, leading funding platform in the world. We're distributing millions of dollars every month. But that's the background, and we'll just fast forward here based on that experience. So crowdfunding is actually not a new concept. Most of you have heard that the Statue of Liberty was a gift from the French, but what you didn't know, or some of you know, is that actually the base was crowdfunded. So it cost nearly $300,000 to get the base built, and the government was able to support only half of that. Private investors were able to support half of that. So Joseph Pulitzer, who most of us know at the time, who was working for the New World, the precedent to the New York Times, used that medium to reach out multiple times and was able to raise all this money. So the amazing thing is not that he raises the money, but that he raises it from so many people. and he doesn't give anything in return except for we're going to have the Statue of Liberty. So the average contribution was 83 cents. So there's like 140,000 people that give money from asking for something through a medium which only goes about, what, 10 miles, 100 miles, whatever you want the distribution of a newspaper to be. Pretty remarkable. So if you fast forward, you have today, you have the internet, the distribution mechanism is much faster, and you can ask for different things. You have a new opportunity. So I just want to say that Indiegogo and crowdfunding is not really so novel. It's really just using the latest technologies to apply old concepts. So crowdfunding, really simple. I know you're all very smart. Obviously, you're here in Stanford. I always want to get into Stanford. But crowdfunding is just the crowdsourcing of funds. So you can crowdsource lots of stuff. You can crowdsource ideas, videos, pictures, whatever, but it's really quite simple. Crowdsourcing and crowdfunding are not the same thing. Crowdfunding is just a flavor of crowdsourcing. So here's the kind of history of Indiegogo. We'll kind of go fast through this, but really we launched in January 2008. We started out like Amazon in one vertical. We tested out for a couple of years. We deal with the market crash of 2008, 2009, which I'll talk about in just a second, which kind of sucked also. And we then expand out our product in December of 2009. We've seen month-over-month growth since then. We're now distributing millions of dollars every month in virtually every country of the world. And just a couple of weeks ago, we announced our A round from Coastal Ventures and Inside Venture Partners of $15 million. So we are hiring. We have some new people here, and it's very fun. But crowdfunding to us is, how should we say it, not new. We've been working on it for a while, so it's pretty exciting to have it all happening. We actually were the only funding platform that was at the White House as part of the Jobs Act. We actually had our case study for Emmys Organics on stage with President Obama. So it's one of the case studies of what it's like to have this whole crowdfunding story. To give her story, so you can make it very real, she's a for-profit small business that wanted to get a loan from a bank in upstate New York, totally for-profit, totally had money. And they were making lots of revenue, and they wanted to expand their production because they wanted to sell in more states, and they wanted to change their branding and packaging in the supermarkets. So they went to their bank. The bank turned them down. And they went to Indiegogo, and they raised the money they needed by offering different products and pre-sales of their gluten-free desserts and such. So that's actually, it's in the White House blog, and that was actually what was on stage with President Obama. But that's kind of just an example. There's lots of other examples. We've had the first ever crowdfunded baby. That's correct, in vitro fertilization funded on Indiegogo. The baby was born 2 months ago. Right here in Stanford, we have social sharing glasses where you can do video of your glasses. You could check out that campaign. Some of you might have heard of the oatmeal campaign. Anybody? Oatmeal? Yeah, there you go. Pretty hot campaign right now, but lots of stuff going on. On Indiegogo, there's absolutely zero judgment. We don't believe that judgment should be allowed in a crowdfunding platform. It just perpetuates the historical way of doing business. If you have the internet, why stop things? Let anybody find market supply and demand to each other. So here's actually some of the reasons why people should use crowdfunding. I mean, the money's nice, but I would actually tell you if you just want money as a business, don't do crowdfunding. It's actually quite hard work, but you get a lot more benefit out of the money, as some of your investors and people here who are VCs and angels will tell you they're value add, all that good stuff. So what you get actually out of crowdfunding is very tangible things, which is one is you get to gauge demand and mitigate risk because you have pure information coming in with data and pre-sales, right? You don't have to guess. Number two is you get more promotion than you ever could on your own because you're in a platform that will get you more promotion. You actually get to test your marketing very nimble. Instead of investing all this stuff into one type of marketing, you can test different approaches. You actually will capture the data, which is probably the most important thing, which is your D2C, right? Direct to customer. There's no disintermediation between another outlet who owns the information and you have to rely on them. So that's really what crowdfunding is all about. And also you get money, which is nice. So here are some of the reasons why people actually will actually give. So number one is because they care about the campaign. Number two is because they want the perks. Over 90% of campaigns on Indiegogo that actually reach their target will offer perks in return. Carl called it rewards. Number three is because they care about the community, like the Statue of Liberty. Number four is for profit. They want to give $1 and get $5 back. Here's how you actually have a successful campaign. I can spend 5 hours on this, but we'll just leave it at these 3 points. Number one, have a good pitch. Number two, be proactive. And number three, find an audience that cares. So I could go through this for a while, but the team at VLab wanted some really unique content. So on the right here, I actually came up with some interesting ideas. I did it on my cell phone. So based on my experience of Indiegogo, both starting Indiegogo, working in Indiegogo, and seeing all these different entrepreneurs who are actually on Indiegogo, here's some, should we say, myths of startups, whatever. Please understand this is just like riffing here on the ride down. So number one, that there's the right time to start a company. I don't believe that. We started in January 2008. It was clearly the wrong time. We dealt with the entire market crash. We're doing okay right now. I think as long as you persevere and persistent, you can figure it out. Just don't waste your money right away. Which is the second idea is you need a lot of money. We bootstrapped everything for a long time. I told you we just raised our A round, not our D round for 15. It's because we bootstrapped. We were kind of trying to be frugal about it, which I'm not saying everybody should be frugal about it. There's something smart about raising $41 million and just blowing it out of the water, whatever. But it's not what we did, and it's kind of just what I learned. Number three is you need a business plan. This is actually probably the most interesting one. I think that's complete and utter garbage. Do you need a one-pager of an idea of this is what your target is? A crowdfunding campaign is basically your ultimate business plan, right? Because you're putting it all out there, and you're seeing the demand. So like the old days, you actually needed a business plan, which is 30 pages, and you actually had to do a bunch of research, and then you had to hope to bring it to market, and then you had to hope to somebody will do something about it. But see, now the way the internet works and the way you could all be connected, all of that collapsed. So like, those 25-page business plans? Yeah, no. So the next myth is it's all about the idea. I think ideas are interesting, but I think it's like mostly about the execution, but you guys know that one already. So I'll say it a little differently, which is it needs to be really complicated. See, especially here at Stanford, and I went to Penn, so we all think we're very smart. So we're actually more intelligent than most of the world. So we're going to capture people in our complicated, strategic, visionary stuff. So what happens, we use this Octopus approach, and I see I'm at 0, but I have like 30 seconds left. So they use the Octopus approach. So if you have cellophane, right, and you have an octopus, you have 8 tentacles, equal distribution of pressure across the cellophane, you'll never break through, right? And they get really frustrated. The octopus is like, oh my gosh, why am I not breaking through? Because 8 equal distribution of pressure, when really all you need is a simple knife, right? Very low pressure, break right through. But because we're so visionary and so smart, we try all this complicated stuff because we're going to capture them in our wicked web of brilliance, right? And I did this with our company. That's why I know it's a myth. We failed completely, and we improved it. So the last one is, let's just stop there.
So when we were working with the team to put this, this session together, one of the things we wanted to do was obviously represent the broader marketplace. So obviously, interesting hearing Slava talk about one of the leading examples of a reward-based model. But we've also got Ryan with us, who, as he mentioned, I think, did you say 4 months ago?
60 days.
60 days ago. That's 4 months in my book. 60 days ago, basically launched an equity-based platform. And obviously, some of us here, we have different perspectives on this. Some of us are actually interested in this from an investment point of view in terms of whether we can find ventures to fund through these vehicles. Some of us are actually interested in the asset class itself. And obviously, a lot of people are interested in whether crowdfunding as a new instrument for raising capital is something that is viable. So let me just start while I'm gathering up here and walking around there. Maybe you could give us a few minutes, just maybe a couple of minutes in terms of explaining your model, because I think it will form a good basis for the discussion.
Sure. So we are an equity-based crowdfunding site. We allow investors to invest in established businesses in the consumer product and retail space and receive equity in return. So they either invest and kind of sign standardized equity documents or convertible notes. We have kind of taken a step back and kind of why we focus on consumer product and retail companies. We have a strong, and I'm sure what will be an unpopular view in this room, that there are a lot of industries that have efficient funding. Technology is one of them. Our firm, our company, raised money very quickly with what was a business plan, although Slava says not to put one together. We did. We had no experience in technology. We raised money. And I think it's because there are thousands of venture capital firms in the country that will invest into technology companies. There are other industries, though. Consumer products and retail is one of them that are underfunded. So in our economy, consumer products and retail is about 20% of the U.S. economy. It's only 4% of angel funding. There are not a lot of angels, not a lot of VC funds that will invest in those types of businesses. That's why we think it's a good place to present investment opportunities for investors. If we took the kind of reverse opinion on that and we instead presented technology companies, in my view, we would be presenting investors with companies that all of the venture capital firms and all of the angels in the country had already passed on. And we think that's a really tough way to make money as an investor. So we focus on a space where we think there's little competition, where we believe it's inefficient. The basic model is investors come on, find companies to invest in, wire money to a third-party escrow. If the company hits their target, the money gets invested into the business, and you're an owner of the company.
So obviously, you know, central to today's discussion is obviously sort of how disruptive these models are going to be. So, you know, again, let me just challenge you, Slava, on this. So, you know, obviously, Indiegogo and other sites like Indiegogo have sort of raised our awareness of, you know, new projects. It's enabled, you know, participation sort of to reach a different level. Do you think the reward-based model in itself, you know, how big is that? How disruptive can that be?
I think it's kind of binary. Either you believe in crowdfunding the way it's being done today, or you don't. And if you're a naysayer, that's fine. But if you do, it's kind of hard to explain how big it is. Every single industry will have crowdfunding being done, in my opinion. To put a perspective on it, and when I say crowdfunding, I mean what you call rewards or we call perks-based crowdfunding, so definitely not equity crowdfunding. Not to poo-poo equity crowdfunding, but just your question. I think that literally we're talking about hundreds of billions, if not trillions of dollars globally in terms of a market size. Every single industry will do it.
So do you think, you know, is it going to increase in scale because obviously it's going to become more pervasive and it's going to reach, you know, different corners of the world, or do you think that, you know, the amounts of money being pledged for these perks, you know, is that going to change over time?
I mean, you're already seeing in our 4.5 years that the average contribution is going up. You know, we have the largest contribution on any platform, $74. You see the average campaign size going up. We have now single swipes at a time, single contributions, no equity, no profit, no nothing, $60,000 at one time. You know, you'll see, remember when we said the points why people should do crowdfunding, right? It's not just about the money, it was about the data. It was about the mitigation of risk. It was about the promotion. You know, I actually equate it very much to about 2003 in social networking, where it used to be where any corporation, for example, would think of social networking like just for that rock star and poor teenager. I would never touch it, but eventually not only did social networking become part of their Marcom and, you know, strategy, it became the strategy. So similarly, crowdfunding will eventually not be a one-off discussion. It'll just be part of the fundraising process.
So Don, you know, how are the capital markets reacting to this? I mean, people sort of involved in more sort of traditional, you know, funding structures.
Yes. So one of the things I think is really important to do is to have some clear definitions of terms. In terms of the rewards-based or project-based crowdfunding, I think that's totally embraced. I mean, essentially, you're getting, you know, money up front for delivery of products later. You know, what a great model. I mean, that's a wonderful thing from the entrepreneur's perspective. From the equity-based crowdfunding, and in particular, I'm focused on really the conventional Silicon Valley startups, that early stage startup company, not a little later stage of what Ryan's talking about. And in that model, there's really a whole set of landmines and issues with the way that it's currently structured and proposed in the Jobs Act. And I don't know if there's time to, a couple of the details on it is, one is that messy cap tables are a big problem for any kind of follow-on funding from VCs. There's also issues of liability. In terms of that the officers and directors are personally liable. There's also issues in terms of that you have to do a public disclosure of what your business plan is that's filed. So there's no being in stealth mode. You've got to basically open be wide open from the beginning. And I think, in fact, under this model, there'll probably be a certain segment of people that'll be mining those documents for ideas in their checkbooks to go into competition. So that's a few of the things that give me pause.
So we'll keep talking about both sort of the reward-based, perk-based, and equity-based models. I mean, Daniel, from the perspective of the equity-based models, I mean, what do you think it's going to take in order for those, in order for that to work? I mean, obviously, we're all in the process at the moment of participating, but obviously waiting to see what the rules are. We're not yet sure, for example, what the regulations are going to be in terms of the way that portals can operate, how they, solicit, investors, etc. You optimistic or concerned?
Well, I think, first of all, it's going to be a very interesting time to actually review and see what the SEC comes up with when you look at the rules that are going to be promulgated in the next couple of months. And again, just to be clear, the Jobs Act laid the groundwork, and it's clear that what's going to happen is that there's going to be an exemption for private issuers, if you will, and you don't have to file a registration statement. And that's quite important from a securities law perspective, because when you really go back, a couple of years ago, rewind, we had quite a few companies come to us and said, hey, we have this great idea, we want to do this. And we came back and did research, this is again a couple of years ago, and thought, you really have to file an S1 registration statement because you're going out to the public. And so I think to answer your question, the interesting thing will be, will we have companies that actually will be great companies that come out of this crowdfunding situation? Because I think we all know that is going to lead to more, and hopefully we have some real successes. But I do share the concerns a little bit that Don just talked about, and that is, of course, from an equity, again, talking about equity-based crowdfunding. A real problem is, of course, what do you do with a lot of these small shareholders? How do you put that together? For example, I want to see a pay-to-play imposed on. For example, I don't want to. I'm saying, what for example happens if there's a next round of financing and someone is going to try to impose a pay-to-play on all these small investors? What is going to happen in a situation where the company is super successful and the VC comes in and says, I would like to come in? How is that going to happen? And I'd be interested, of course, in what Ryan has to say about that, what kind of thoughts are going into that. I think there are certainly solutions, maybe selling the assets of the company, packaging it, merging it, doing all kinds of interesting corporate things. But to go back, I think the initial thing is crowdfunding is supposed to simplify the funding process and not complicate it, and it may complicate it at the back end.
You got to respond. So I agree strongly with Daniel and Don on a number of different points. I think number one, we as a company are very skeptical about crowdfunding for unaccredited investors. The rules, truth be told, have not been written yet. What we know so far is that it'll be very difficult for an attractive company to take advantage of crowdfunding. We are operational because we go through what's called Regulation D Rule 506, so we are only open to accredited investors. When crowdfunding becomes legal crowdfunding for unaccredited investors becomes legal in 2013, there are a number of different restrictions that I think would make any attractive company run for the hills. So right now, we find it hard to believe that that's going to be an attractive place to play. So I agree on that. I think on the cap table, there's two different issues which I think Daniel and Don were both alluding to. One is what a private equity firm or VC firm would think. The other is what rights these investors have. The way we've dealt with the latter at CircleUp is through an investors' rights agreement. So the company can dictate what rights the investors have below a certain amount. So for an example, if you invest less than $25,000, you don't have the right to vote on whether or not the company gets sold in 5 years. Now, some investors wouldn't want to sign up for that, but it's a take it or leave it situation, and that allows the company then to say, look, we've got this group of shareholders, but they can't hold up a sale, they can't make major decisions. So that's how we deal with it. The other issue around the cap table is when you walk into a VC, when you walk into Kleiner Perkins and you say, yeah, everything's going well, but we've got 75 investors. In my experience, so I spent the last 7 years in private equity. In my experience, a VC firm that makes 30 investments or more a year has a lot of opportunity to invest in a number of different companies, and they can make the decision to pass. That's yet another reason why we think crowdfunding is a very bad solution for tech companies. Again, it's not a popular view in this room, I'm sure, but we don't think if you're going to go raise money from Kleiner, they are going to look at that and they're not going to be pleased. When you're the type of industry that doesn't get funding from VC, and your next round is typically when you're at 15 million in revenue and you're going to a private equity firm, which is much larger, the private equity firms will not look at your cap table until they've signed the LOI, until they've spent $50,000 in legal fees, until they're far along in the process. And I would urge, if there's anyone who's in private equity here to speak to this, I find it hard to believe that when a company makes 2 investments a year, they're going to walk away because the company they're looking at has 25 investors instead of 5. But underlying that is the premise that they're not going to take advantage of the crowdfunding exemption. They're not going to bring in 2,000 investors. We think that's a very bad decision.
So actually, just to put a little bit more color on this, I think we're underestimating the number of investors. Looking at one of the crowdfunding platforms in the UK, they use crowdfunding to fund themselves, and they raised the equivalent of 470,000. It was 162 investors. Yeah. And so the accounting overhead of that is just a nightmare. I mean, if you have to go out and get a sign-off and increasing the stock option pool, are unaccredited investors even going to know what a stock option pool is, much less vote on it? And so where I think what will happen in terms of a VC follow-on is that either won't be an on-ramp at all, or the company has got to break through with some level of success, then it makes it worthwhile for the VC to do the cleanup necessary.
We agree with you. So that was, as a tech company, we actually cap the number of our investors in a given round far below that for that exact reason, because we don't think that a small company can deal with that many investors. I think the part of the Jobs Act that was most overblown is raising it from 500 investors to 2,000. Everybody makes a big deal out of Facebook going public because they couldn't have more than 500 investors. In my opinion, that's just junk. There aren't a lot of Facebooks in the world, and there aren't a lot of companies that can deal with 500 investors, let alone 2,000. We cap our number of investors far lower than that. We closed our first round for the first company that raised money on CircleUp. It took 14 days, $500,000. The average check, we helped them raise a portion of that, $200,000 of the $500,000. The average check was $10,000. So we had 20 investors in ours.
So a lot of the, obviously a lot of discussion there around the, impact from an equity-based model. Now, Slava, in terms of the model that's working, we can see it's working, we can see it's growing. What sort of impact is the success or failure of equity-based crowdfunding going to have on the current model? I mean, how do you see that?
I think it's really interesting. We at Indiegogo are very pro equity crowdfunding. We were in DC lobbying to have it happen. Philosophically, the whole idea of democratizing funding for anybody to be able to fund anything for whatever reason they want to fund, whether it's one of those 4 reasons, is totally in line with what we think. As a business owner, as somebody who needs to try to decide which market to move into, a lot of people have, even the media recently was asking about our $15 million raise, which happened just a little bit after the Jobs Act. They were like, wow, the Jobs Act had like a really big impact. Like you just closed like a round like in a week. Good job. And for what it's worth, it has nothing to do with it. I mean, equity crowdfunding, any VC worth their salt would not roll their dice on something that doesn't even been written yet, right? So I think equity crowdfunding in theory is awesome. We at Indiegogo are going to be looking at it. We're totally, obviously looking at what's working and what's not working. And, for now, we need to keep our core business growing.
So some people are rolling dice because, I mean, some of the equity-based platforms are raising money. I heard about another one today that's announcing on Friday. So, I mean, the money is coming in there. Are you going to keep away from, did you say, non-accredited investors, did you say? So you're only going to...
It's a wait and see.
Wait and see.
Yeah, the rules haven't been written yet.
So,
just about that, I mean, the whole concept of accredited investors, that's just pure silliness. I mean, in 1933, because some grandmas, have a hard time and get defrauded, that all of a sudden there's some arbitrary number as to you're smart enough or have enough money to actually understand something. How non-American is that? That's like the most ridiculous concept.
Oh, I mean, 1933 has never repeated itself, has it?
Right, with the rules.
No, I'm just joking.
Yeah, I mean, it's just like the concept of an accredited investor. I mean, don't get me wrong, I'm not trying to have people lose their money. I mean, we don't even have equity on Indiegogo, so it's not as if we're even dealing with it. But the concept itself is so arbitrary.
So if we can't distinguish between, types of investors, smart ones that should know what they're doing and deserve to lose it if they make mistakes, and then others that, perhaps need a little bit of guidance. I mean, what obligations do you see you have as a platform that's starting to raise, substantial amounts of money for entrepreneurs that, we know a little bit about them, but we don't know that much about them. What obligations do you think the portals carry for making sure that we spot and rule out the bad actors?
Yeah, I think that's a great question. You could have positioned it saying now that equity crowdfunding is going to happen, but the funny thing is it has nothing to do with equity crowdfunding, and that's what we have to answer. Because we've been around for whatever, nearly 1,700 days, and if on day 160 or 600 we actually had a lot of fraud, what would happen? We would go out of business, not because the SEC saw us, but because customers actually just wouldn't use it. So it's in our best interest to actually have a platform that works where people are not getting defrauded left and right. What do we do about that? We don't discuss it in detail, but like MasterCard or like PayPal or like banks, they have to worry about fraud. And anytime you're dealing with millions of dollars going through your process, there's going to be some bad actors. So we capture our data correctly. We've come up with our own algorithms of how we measure all this stuff. And the beauty actually of crowdfunding, which is very different than these other actions, is the crowd actually can help you figure all this out, which is how we manage it.
So I don't know if I'm allowed.
Actually, I'd like to jump in on just a couple of points there, if I may, and that is that there's also a point that's short of abject fraud. One of the challenges with investing in early stage companies is you're always going to have a lot of unknowns, and you're going to have to really sort of fill in the gaps on that. One of the huge things and one of the huge criteria is the integrity of the entrepreneurs, because you're really trusting them to get off and run with the business, run with your money. And so even short of fraud, just having someone that you can literally trust is a key issue in finding a company that you're going to invest in. And being able to make that evaluation from a distance arm's length or over the internet is very difficult. It's difficult in person. The other thing is I would like to challenge a little bit the underlying assumption of the wisdom of crowds in the financial markets. Herd mentality springs to mind, and it's been consistent through history from back in the 1600s of the tulip mania for those from business school to the dot-com bubble to we see that repeated over and over again.
So, Don, you're obviously a little skeptical with respect to to say the least, I guess, with respect to whether an equity-based model can work. And I think we had some conversation about one of the big high-profile. I'll ask you as well, Slava, for an example soon. But we had one of the highest profile was obviously the Pebble Watch example. And when we were talking about that, we remarked that 67,000 people pre-purchase. Now, pre-purchasing is not the only reason people participate in those rules, but 67,000 people. Do we think those 67,000 people, are not smart or are not communicating some very substantial messages in terms of the market readiness for that product? I mean, is that valid or not?
So in that case, we're not talking about financial markets. I mean, we're talking about people making a decision about a consumer product. And perhaps all 67,000 people are made a great decision for having a watch that they'd want to have. One of the questions that I would wonder is, I'm guessing, I don't actually know, But the few people that cut a $10,000 check for 100 watches really wasn't planning to wear them all. And I'm guessing they're probably speculating in the idea that this is going to be a real hot item that they're going to be able to, somehow sell them for a profit. Maybe they're right. More power to them. I think that project-based, that context is really quite different from the equity-based. And the other thing that just to kind of follow on with the Pebble Watch too is because we always point to that because, my God, it was 10 million bucks. I mean, you get any company where you can bring 10 million bucks into the coffers as on pre-sales is just a wonderful idea. But you start looking at the stats, and I think the average raise is less than $10,000.
The average raise of what?
For the project-based funding. And I think the average contribution, I think you were saying $74. I think it's kind of, and the median's about 25. So at least so far, on average, it has not been large amounts. So we need to be a little careful about just focusing on the exceptions.
So our friends at Pebble Watch, they were turned down by six venture capital companies. So how come they have a product that 67,000 people are dying for? They make a manufacturing run of 80,000 and pre-sell 80% of the stock. But every single one of the VC companies that looked at it thought it was a really, really bad investment, really bad idea.
So we don't know yet whether or not whether or not it'd be a good investment for an investor return.
Well, yeah, venture capital firms tend to not invest in consumer products.
They tend not to invest in consumer products. What's the IP position? How do they have any kind of blocking barriers to competitors so they can have a sustainable advantage? I don't know the answers to those, but that's to be told, and that's one of the things that you don't actually find out whether or not you've made a good decision. Oftentimes for 10 years, you don't get feedback on decisions in investing in startup companies. So we actually can't answer that question for a number of years probably.
The average small business in America is actually started on less than $10,000. The Pebble Watch example, it was actually trying to be a financial instrument first, but people rejected it multiple times. The reason for that is because there's a broken system as to how money can find people. You put the power into the hands of individuals, whether they're at the bank to decide if you deserve a loan, or at a credit card company to decide if you can extend your credit, or at a government agency to say that you actually deserve this grant. It's just fundamentally broken. And having an open marketplace with no judgment allows itself to find itself. We listed the 4 reasons why somebody funds, and the challenge is most people actually want to box that up. See, Don purposely tried to make it sound that actually wasn't crowdfunding, that was pre-sales. But see, we use these words like donate, buy, gift, pre-sale, perk, whatever. You know what it is? It's all movement of money. It's all, instead of a world of transactions, it's a world of relationships. Right? People want to actually be part of what they're actually buying or participating in. And whatever that or participation, whether it is that watch or that feeling or being part of the community, or for some people they want raw, hard cash in return, it's for people to decide, not one person in a suit typically who's using a risk model which is 20 years old that has no idea how the market is evolving with the internet to decide.
So we're going to want to broaden out, but if I could respond briefly as as we ping pong back and forth. But so the key distinction for me is a distinction between project or rewards-based crowdfunding, in this case pre-sales, versus equity-based crowdfunding, and it's the equity-based that I have troubles with. And I do in fact think that there's going to be segments such as what Ryan's working with in the consumer product space, where it could become an alternate vehicle. And in particular, as I work a lot with syndications with different angel groups across the country, and there are angel groups in other areas of the country where their problem is deal flow. They do have money. And in particular, oftentimes with angel groups, there's a real premium particularly outside Silicon Valley, to be able to be doing some economic development locally. So they want to reinvest and give back to the community. So being able to have another platform or another mechanism for people that have interests other than ROI, I think could end up making a lot of sense. And so I think there may be some coexistence. I just don't think that there's going to be a very good overlap between venture funding and equity-based crowdfunding.
So, so Daniel, what about sort of regulations and things? So obviously, to bring us back, so we're going through a process at the moment, obviously, where some of the rules already in terms of the disclosures that the entrepreneurs, that the crowdfund issuer has to disclose. Do you think the same should apply on reward-based platforms? Do you think reward-based platforms should be regulated?
No, I don't think. I mean, so first of all, full disclosure, our firm actually represents Kickstarter, so I have to be careful what I say and don't quote me. But ultimately, I think the biggest problem is that American society is very litigious, and we all know that. And just a couple of years ago, I had the good fortune of, working with a bunch of sort of interesting new business models. I'm just going to name a few, but or one maybe like penny auctions and other things. And I can tell you, a lot of these companies got shut down. And I'm not saying that this is going to happen to rewards-based crowdfunding, but I can tell you one thing, that because it's going to get more prominent, it is becoming so prominent, there will be a bigger target on its back. And ultimately, we have, as you know, a hodgepodge of regulations in this country. Sort of just the strangest things to pop up, as we all know, in every single state. There's federal regulations, of course, but there are also state regulations. And so, just to name a few, we have. I don't know if anyone has ever heard of, for example, sports memorabilia. For example, so if for example you were to give away certain things, like sports memorabilia or fine arts or other things, there are some really arcane rules and potentially ridiculous fines that can be imposed. And the attorney generals, frankly, have sometimes nothing better to do but to prosecute people who are actually trying to do something fun or new or innovative. And that is going to be a big issue. And I think, so it's a little bit the sort of Napster problem, if you will. You're building a platform, and all of a sudden, the platform gets attacked because people are doing things on that platform that are not completely legal. And I think that's going to be an issue. And I wonder, there are plaintiffs' lawyers out there, they do nothing but look for those types of things. And when you have, for example, a specific reward that sort of falls flat on one of those statutes, or at least there's a colorable argument to be made, they may come after not only just the company, but also the platform. And I'm a little bit worried about that, frankly, but the proof will be in the pudding, and we'll have to see what happens.
Ryan, are you, I mean, the whole issue around sort of being able to offer or not offer investment advice and sort of that, that grey area, are you concerned at all in terms of the policing of this, next year? And specifically, what you are allowed to do and what you aren't allowed to do?
We are concerned with it in that we hope that the SEC polices it, and FINRA more likely, but we hope that there are regulations. Without that, the industry won't exist. I think the industry will lose credibility very quickly if there are 5 cases of fraud, right? And so we are rooting for FINRA and the SEC to put in place the necessary restrictions to protect both investors and companies. In advance of that, we have put in place what we think are appropriate levels of restrictions to protect both sides. But we hope that happens.
For the fun of the panel, I actually totally disagree with that. I'll say totally for the panel's sake, but 20 years ago, the internet opened up to commerce, and this exact same discussion happened, with how should the government regulate this thing called online commerce? Which new laws should go into effect, which new policies and which new regulations? And a very smart thing happened, which was industry said, give us a year or 2 to figure this out, just kind of step off. And for some reason, government was willing to be smart enough to say, okay, go ahead, figure it out. And you know what? By letting them do what they needed to figure out themselves, because they, as corporations that want to be profitable and make a lot of money and serve a lot of customers, need to figure these things out, we're able to have the opportunity to figure it all out without handcuffs and without limiting how they can grow, which the same thing is necessary for, in my belief, any evolving industry, including you know, this crowdfunding, whatever you want to call it.
Yeah, I think that's right for rewards-based crowdfunding. You know what I would say about equity-based, I mean, it's a capital market. We are building a capital market, and I think you know, the idea that there should be less regulation in a new and innovative capital market, I think over the past couple of years has been proven to be wrong, but that's just our personal view.
Well, more regulation has been working.
No, I think that's actually really important, because I think one thing will be very clear. Once we will see the regulations, I can guarantee you that the SEC, first of all, I mean, it's no secret, Mary Shapiro does not like the crowdfunding, the Jobs Act, the crowdfunding portion of the Jobs Act. Yeah. And you know, these are people, not to disparage to the SEC, but these are people who are looking for plain English in our prospectuses, where all of us believe that anyone who actually can read understands it. So, so I'm wondering what is going to happen in this situation, and I'm actually quite worried that there will be a situation where ultimately you could run into you know, some pretty nasty regulations that are not going to help the crowdfunding platforms at all. So I'm just worried about that, not from the regulatory side, not from as we know, the legislators, as we just heard from Senator Brown, they've put this in place, but we've also seen how perverted some of our, you know, acts and have become through the rulemaking process. So I'm a little bit worried about it, frankly.
I totally agree, and it's totally not a slam dunk just because it was signed as a, you know, visual PR thing in April. It's far from the slam dunk, you know, which is why, you know, when people ask, I mean, we could raise money for something that already has 4 years of traction. But just to step back just a hair, regulation or not, just think about this for a second. The only reason probably why the Jobs Act actually passed, right, is why. Not because anybody needs a new financial instrument. It's because the economy sucks, banks are not giving out loans, people are not getting jobs, right? And crowdfunding is proven, not potentially, proven to create jobs, right? Like we have campaigns on our site of retail stores that are opening up in malls where they started, you know, with 2 people raising a campaign, now they have 16 employees. We have people that are actually raising $1 million of VC money after raising money on Indiegogo, and now having 13 people. You know, those are like real examples. So that's why this all happened. So I know there's a lot of talk about the regulations and all this stuff, but it's really about the proven job creation.
I mean, Don, that's another thing I hear, that from the perspective of the current capital markets, there's been a lot of small ventures, entrepreneurs, small companies that are just off radar. And there's quite a lot of people interested in seeing, obviously, you know, what can emerge through crowdfunding in terms of, you know, seeing the deal flow earlier.
So I'm not quite sure I heard the question in there, but so just kind of talking a bit, perhaps to follow on with Slava there, with the jobs creation certainly is what's driving all of this, and there is very good data that shows that the job creation is done by young companies less than 5 years old, and so. And at this point in time, I mean, there's some $18 billion being invested by angels, and both local, primarily in local businesses. So there is certainly a robust funding level out there in the angel community. One of my big fears coming out of all this is that may get jeopardized. And you know, and hopefully this never comes about, but too often what will happen is that if something crops up that's problematic, is that the government response tends to be done with a meat axe and a very broad-based, and tends to hit a lot of unintended areas. And so I am concerned that there will be at some point down the line some sort of backlash regulation from the government that spills over and really has a negative impact on what is a robust startup funding community.
So let's change topics. What about from the perspective of entrepreneurs that want to approach these platforms to, to raise funds and things? I mean, again, we've got opportunities here to get advice from sort of two different models. So what would you say to entrepreneurs in terms of how to best approach these campaigns? What makes them successful?
Sure. I mean, in general, I think it's really exciting. I think it's one of your many options, and people should consider all their options. I talked about why they should raise money as to what are the benefits besides just the money. But just really quickly, as a high level, based on our nearly 100,000 campaigns and tens of thousands of campaigns that have hit their targets and millions of dollars distributed every month, the data shows a few things. Number one is you want to have a good pitch. Number two is you want to be proactive. And number three is you want to find an audience that cares. Having a good pitch, we know that if you have a video as part of your campaign, you'll raise 114% more money than if you don't have a video as part of your campaign. We know that the average length of a campaign that hits its target on Indiegogo will hit its target on day 36 of a 47-day campaign. Campaigns that do not hit their targets will be 56 days long. So the longer your campaign, on average, the worse. We know that over 90% of the campaigns that hit their targets will offer perks in return. Over 80% of them will offer 3 to 8 perks. Number two is you want to be proactive. We know that email is your number one tool, hands down. Facebook is number 2, and Twitter is number 3. We know that if you have 4 more people as part of your team, you'll raise 70% more money than if you have 1 person. If you do 5 or more updates, if you do an update every 5 days or less, you'll raise 4 times more money than if you do an update every 20 days or more, right? So keep the campaign fresh and keep talking. Number 3 is we know they need to find an audience that cares. Typically, your first money in, whether it's for angels or VCs or anything, and especially in crowdfunding, will be through your friends and family. So 20 to 40% of your funding will first come through your own social graph. You'll get no money from leprechauns on Indiegogo or any site when you have a zero-funded campaign. So once you actually hit that level, you can start getting the social proof that strangers will start to want to fund you. On Indiegogo, we have a proprietary algorithm called the Goggle Factor because we actually don't even have subjective opinions on how good your campaign is. Our algorithm, like Google PageRank, will determine where to place you on our site or which media promotion to push you out into. So then you can have people start funding you. On average, 20% of your funding on Indiegogo will come from complete strangers, which means 80% comes from people you know. Some campaigns will have over 95% of the money come from total strangers. So that's what we've learned from a lot of data. I used to have opinions, but now I don't have them.
Is that data available on your site?
Yeah, so we put out, we're really proud of the fact of trying to use all this data to educate our customers. So we have our customer happiness team, which is all about making sure you're as happy as possible with 24/7, and you go into the blog.
24 hours voicemail.
Voicemail?
Yeah.
Well, we're email. But yeah, so you just go on our blog. We have insights, where we have new insights every few days.
And Ryan, do you have enough, obviously track record yet? I mean, obviously you've probably been looking at other people's models for some time.
Yeah, we don't nearly have nearly as much data. I mean, I think what we've learned so far in the deals that we've closed is a couple commonalities. A big difference is valuation matters, right? For us, valuation is important when you're investing in a business as opposed to giving money as a donation. 2, social proof, I would agree with Slava there, is critical. On our site, you can see when other people have invested, that momentum helps, but also who has invested. So as an example, one of our first companies, MD at a very well-known investment firm was one of the first investors through into the business on the site, and that social proof meant a lot to the other investors. I think 3 is just having a business and a product that people relate to. And I think that there's some commonality in what Slava was talking about too. A product that you can see in the shelf, that you use, that you understand, and you get excited about.
Don, can you see sort of the way entrepreneurs normally put the proposals together, and obviously meet and network with the VC community? Can you see those same types of behaviours and patterns transferring through the crowdfunding pattern, or do you think it will be different?
So it's not going to be identical, but I think that there's certainly some similarities. The executive summary, and I agree with Slava totally, the days of the 30-page business plan are long gone, but the days of the 15-slide PowerPoint is here to stay, at least for the foreseeable future. Having a short video where at least you get some sense of who the entrepreneurs are There's a deal management platform that's used widely in the angel community called Gust, and that's been quite helpful for sharing deals, doing an initial screening. Those dynamics will stay the same. It still moves up to more of a face-to-face interaction. There's also, and again, getting back to that, I think things will segment both by industry, as Ryan was talking about. Consumer products has some good traction for crowdfunding, equity-based crowdfunding. I think also by geography, and you know, in the accredited investor community, there's also AngelList is used quite a bit, and there is really a clear demarcation between technology companies and non-technology companies in terms of things being successful there. So, so yes, it'll be the same but different.
So, you know, looking ahead and looking out, obviously, if new companies and startups like Kickstarter and Indiegogo and others can come into sort of this space and claim it, you know, looking 3 or 4 years out, do you think there'll be entrants from other categories within the marketplace? Who's going to be dominating this space in a few years' time?
Well, so the crystal balls are always very tough, so I certainly need to say Indiegogo. And I should say that I fundamentally believe in the personal responsibility aspect that Slava is talking about. And so I certainly come from that ilk. And I think that there's probably, in looking at the entire spectrum, I think there will be you know, certain industries and certain geographies that where crowdfunding will do well. I just am quite skeptical that it's going to mix on a routine basis with VC funding. I think that'll be more on an exceptional basis.
I was wondering about new entrants as well, because obviously one of the things that's an imperative is obviously imperative is obviously the extent of the community and the ability for people to be able to come in and not only aggregate their own community into the crowdfunding community, but obviously to be able to leverage the community that exists. So do you see these e-commerce sites or the big social media sites having a chance?
You know, in terms of that, I think it'll be a similar kind of dynamic. I think there'll be a lot of entrants into the field. It'll get very noisy, and then there will be a consolidation either through roll-ups or from companies going out of business until you end up with, you know, I'll say a few, but, you know, it could be a couple dozen, but, you know, kind of really dominant players. I mean, that certainly has been the model in e-commerce. There's not a whole lot of places you're going to go to buy online books. You know, there's not a lot of places you're going to go to do online auctions. I think there'll be that kind of consolidation will go on, but it'll take time.
What do you think, Slava? I mean, apart from world dominance by Indiegogo, I mean,
I did have to answer this question for the VCs, so I probably should have an answer. You know, I think I used to be a strategy consultant for 8 years, so like Don said, I mean, it's kind of obvious that a few players will figure out the industry, money will start following it, there'll be lots of fragmentation, people will open up by geography, by vertical, by business model, and everybody will try to be creative, it will start consolidating, so that's just high level. But in regards to crowdfunding, I actually think that the equity thing is really a kind of unknown, so let's just put that aside for a second. Crowdfunding, as we know it today, only, I think is really interesting. I think people are really, like actual quote-unquote businessmen, you know, in charge of like important corporations, are really starting to see what's going on here. This isn't just like some little bands or even, you know, some watch that's getting funded. What's going on here is like really free and fast R&D. There's co-creation, there's a lot of data, there's propensity to buy information, there's trends analysis. There's a lot of like really, really meaty stuff going on here. So you'll see that I think this will shift away from just the one-off platforms, which will be an interesting competition and, you know, market in itself, but full-on Fortune 500 companies and governments and countries will get involved with all of this because they'll see how it's a great way to be D2C and create relationships instead of transactions.
So I was approaching my B and C questions then, because I didn't realize if I flipped this iPad thing up. Some great questions from the audience here, or from the participants, so we should go through a few of these. I didn't think I needed a lesson to use an iPad. But so a couple of questions for Ryan and Slava. What are the things that concern you most about, what are the biggest challenges, things that concern you most at the moment about sort of your own company performance?
I can start. I mean, given we're so young, there's not a lot that I think we've got nailed right now. I mean, it's getting scale, I think, is the biggest issue for any company of this size. So, getting your name out there, but also doing it in a way where you think you're really providing value to both sides. And that's more than just, in our case, that is more than just connecting an investor in a company, but it's providing great companies for the investors to invest in, and providing investors that we think will bring value to the companies beyond just writing a check.
You see your greatest challenges?
Yeah, the two things is obviously we just raised money, so it's about people. It's about hiring the right people and making sure we're empowering people in the position to really take over important parts of the business so we can grow. So hands down. And then the other thing is, this is a standing room only room. And the reason is because a lot of you think there's a lot of opportunities here. So you can only imagine, if you're actually in the middle of one of the companies, to imagine how many opportunities there are. So the problem is actually to maintaining focus and knowing how to put one foot in front of the next instead of running sideways all the time. So it's quite tricky.
So why did you, another question, interesting one, why did you do a VC round as opposed to do your own crowdfunding?
No, that's a perfectly fair question. We thought maybe raising 15 million on Indiegogo might be tricky. But that's...
You could have knocked out a few watches with Indiegogo.
It's because you didn't have a watch.
Fine, wouldn't you? Yeah, exactly. stick the logo. I think you spent some of the 15 million on a new logo, didn't you?
No, we actually raised money after that.
Now, with a watch, it would have been entirely different.
Yeah, stick it on the back of a Pebble watch.
It would have had to be more, just so you know, right? Because if you think about it, if you have the product, cost of goods, so you would have to raise probably, depending on margin, let's say it was 50%, 30, whatever, anyway.
Are we taking questions from here as well? This thing's going crazy.
Plus there's the fees, so you probably wouldn't need to raise 32
probably get dirty hands. Do we have questions as well from the, real? Oh, they're all here, are they? Okay, all right. So there's a question here. It says, can you protect people from themselves? I don't understand it, but I just think
that person wants accredited investors.
I think the question's great. So we spoke earlier about obviously bad actors, but do you feel like any obligation to protect investors from themselves as well?
We let less than 2% of the companies onto our site. So we do feel an obligation to evaluate the businesses, encourage the investors on our site to do their own diligence, but we run background checks. We do much of the same diligence that most investment firms would do in these businesses. We believe then that the investors are fishing from a better pond because of that curation.
So you protect the investors by trying to make sure they have better opportunities to pick from.
Truthfully, the word protect does not come up in any meetings. So that's truthfully, it's not the way we look at it. We look at it more, we want to present them with great investment opportunities.
Right, but what about sort of investor education? Do you see any responsibility in terms of actually informing the investors?
We do. We have a pretty robust investor education section on the site, but I would say that that's something that we are heavily focused on to continue to provide more and more education, both online and off.
So if we go into equity crowdfunding, it's going to be like the cigarette labels, so like you will die if you smoke this, right? So like when you get onto our equity crowdfunding platform, it's going to say, please know you are losing all of your money now. If you'd like to proceed, click here.
We did the Kauffman Foundation.
I think that's true. I think there will be that kind of disclaimer universally.
There are, yeah, there are.
It's going to be a picture of you losing your money.
Yeah.
I think I just wanted to step in on that. I believe that's probably true. There's some, those stupid disclaimers under the seat. You fall off the seat and then you see it. But I think the SEC is not going to be too interested in this stuff, in the, again, equity-based stuff, unless there's like sort of this fraud on the market. And I think the SEC is very keen on protecting the US capital markets as the strongest capital markets in the world. And if there's any inclination that people are defrauding outside of the United States, people, and then the U.S. markets, capital markets, get a bad reputation. That's going to be then there's going to be a backlash. And this is the other thing I just want to mention. I mean, we've seen so many witch hunts. You know, after Enron, after all these different, after Tyco, et cetera, you have these backlashes. And so, you know, the regulations hopefully are going to walk the fine line of regulating an industry, but not over-regulating it. And just to go back, I think the great thing about crowdfunding, and I've said a lot of negative things or critical of it, the great things about it is really that it should make capital markets accessible to companies that otherwise just literally have no access to capital markets. And that's why, for example, Ryan, I think your vertical is perfect, because this is the biggest issue in consumer. Virtually there were very, very few VCs, very few angels and others that really understand it and really financed it. But the regulations ultimately, you know, could be either border on the absurd and ridiculous to hopefully something more reasonable. And that's what we're hoping for when the regulations come down.
So we've got a number of questions coming. Let's try and get through a number of these with sort of short focused answers. So are there tax implications regarding entrepreneurs that have to consider when they consider these various different models? Is there tax implications across the four? You want to take a shot at that?
Well, first of all, I'm not a tax partner, but let me just venture out there. So from an equity perspective, I don't think so. I mean, people are going to make an investment, and as long as they hold the securities long enough, they get the benefits of everyone else, you know, from capital gains perspective. The issue may be, it is an interesting issue, for example, in the rewards-based, and now if you look at the rewards-based model, is there potentially something that you're getting of value that would be deemed potentially to be income to yourself? I don't know. I mean, did you guys look at this? I mean, I'd be interested in there could be certain rewards that could trigger ultimately an income tax reporting obligation, I would imagine. But those would be quite few and far between.
Yeah, I mean, those have to be very large. I mean, $10,000 or something on the reward discount part of it. I haven't run into any special tax situations.
Let's ask another question. How do you believe crowdfunding will affect intellectual property claims? Have you got a position on that?
They all created it together, right? So, no. I mean, all kidding aside. So again, when you look at equity-based crowdfunding, I don't see any issues because people are investing into a company. They're certainly not going to get IP. In a rewards-based model, I don't think there's any real impact either. Again, unless, and this is the bigger issue, if, for example, you are crowdsourcing a particular idea or a particular design, I would be looking to my IP colleagues about what they would have to say about that. If, for example, as people are contributing things, I would imagine you can actually do that, of course, with the platform, and I'm assuming the platforms say that they would have disclaimers, and the companies would have disclaimers if that were the case.
Okay. A question for you, Ryan. What type of returns, and Don, what type of returns will crowdfunders get? Will it be more or less than angel investors?
So it depends on the industry. The Kauffman Foundation put out a report in the past 12 months or so. The Angel Performance Project, we've got a link to it on our site. It depends on the industry. In consumer products, it's on average about 12% IRR, which is not what Kleiner or Sequoia or anyone else at a venture capital firm around here would target. But in our opinion, for the average individual investor, a 12% IRR is pretty darn good. But again, it depends on the industry.
So actually, again, citing Kauffman reports, they did studies of angel investing and found that angel returns were directly correlated to the amount of due diligence that angels spent before making an investment and their domain expertise in the space that the company was that they were investing in. And if, assuming that those dynamics hold, it would certainly suggest that returns for companies that are for crowdfunding, you know, it's a little hard. I mean, in a way, you could say that angel funding is a form of crowdfunding, but as envisioned in this equity-based crowdfunding model for raw startups, not later where Ryan is talking about, where there's real revenues and business models that are proven out. I would expect the returns will be less.
By the way, that's a good reason why we don't like crowdfunding for most industries. So if you take a solar panel company, put it up on a crowdfunding site, there aren't a lot of people in the country that can diligence a solar panel company. I know that I can. But if you put a food company that's at every Whole Foods in the country, we think that that's easier to diligence. You know that product, you know that that food business, you know that brand.
So let's finish on one statement each. Okay. So what's the number one headline that we're going to see in next year's press regarding crowdfunding? What do you reckon it'll be?
Number one.
So give us.
You'll see one bad actor, and it'll be all over the press because all the naysayers will have their turn, and they will be able to say something about it.
So it'll be back. I live in Los Angeles. If I see a headline that says "bad actor,"
oh, sorry. Yes.
I mean, give me something that I can look out for. You know. So Don.
So I think in January the headlines will be that we're still waiting on the SEC to write the rules.
Is this January 2014 or January 2014?
Yeah, and I'm not saying which year. They're already a year behind on the Dodd-Frank rules, and the chairman of the SEC, Mary Shapiro, has already indicated that she thought that it would take at least 18 months to really understand it well enough to write the rules. So 6 months, rules in January, we'll see.
Ryan?
I think the headline is something like transparency is key in crowdfunding. We think that the sites that provide transparency to the investors and the companies and allow them to communicate with each other will be the ones that are successful.
So here's my headline, which is not really a headline, it's really a thought, which is none of us are really old enough to know this, but we can know it from history, which is when the technology moved from radio to TV, okay? When technology moved from radio to TV. For over a decade, okay? For over a decade, the commercials on TV were actually radio commercials with a still image. You with me there? For over a decade, the technology completely changed, but the people making the ads didn't change the ads. And then finally somebody said, why don't we make a TV commercial? So what I'm trying to get at is people are still trying to use the old ways of doing stuff and trying to force it onto whatever is new. And we're starting to see there's the new way of funding.